Can you explain to me how your world has changed from when I studied 3 to 4% FX adjustment on equities, and all of a sudden we're doing dollar adjustment of 6%, 8%, and the CFO of Apple said near 10% yesterday. How does your world change with strong dollar?
Well, the way the world changes from a fundamental point here in the United States is that 70% of the revenues of U.S. companies are actually generated domestically. So therefore, the sensitivity of companies from a corporate point of view is largely going to be focused in the technology sector, where almost 60% of their sales are overseas. So from that point of view, Tom, the translation back is really going to be focused in certain areas as opposed to broadly across the market. When you look at the sales of healthcare companies, utilities, and the telecom companies, even financials, largely domestic in nature, and therefore it's less sensitive than maybe is widely perceived. But it is definitely a concern and a focus on some of the global multinationals, tech in particular.
David, let's talk about buybacks. This came from Market Insider yesterday. Listen to these numbers. Meta spent $45 billion on buybacks last year, paying about $3.30 a share on average. Meta yesterday closed with a 97 handle. David Kostin, what on earth is going to happen with corporate buybacks in the year to come? And just walk us through, because I know you and the team at Goldman do so much work on this, the importance of buybacks as a feature of demand in this equity market.
So, Jonathan, a critical point is the fact that over the last 10 years, every year, the single biggest source of demand for U.S. shares has been corporate repurchases. So question here is, this year, they'll be up around 5% versus a year ago. And our forecast next year is they'll probably decline by about 10%. So 10% less buybacks in 2023 than this year. That's assuming a soft landing. Jonathan, if you had a recession scenario, that's probably down 40%. That is, again, a very significant development in terms of the confidence that CEOs have in the outlook for business activity in the coming year. That does drive some of their decisions on their capital spending. I've spoken to some boards this week as they think about their uses of cash in the coming 12 months, the idea of how important capital spending is relative to research and development dollars. How do they think about the prioritization of merger and acquisition spending? But buybacks has been the default use of cash for a lot of companies, and that is likely to be receding as we look into calendar 2023. And that, again, has been the single biggest support function for equity prices in the last 10 years.
David, just to sort of underline this point, how much do you expect this to pull back in terms of how much stocks can gain, just simply because this massive buyer will not be there?
Well, it's a big issue when we think about the flow of funds. If you want to think about it in that context, Lisa, the idea of pension funds as countercyclical buyers would be one area of source of demand, partially offsetting some of the we feel pulling back on the buybacks. But it's tough to basically replace that when looking at companies spending around $3.1 trillion. That's the cash spending of S&P 500 companies, $3.1 trillion. This year, probably flat in terms of overall spending for next year. And corporate buybacks, roughly $1 trillion this year. And that's likely to be down probably closer to $900 billion in next year. There's really not another source of demand for shares that is going to replace the bid, if you will, from the corporate side.
David, one thing that Goldman Sachs has been out front on is that you don't think that there has been full earnings capitulation in terms of what we can expect going forward. What do you think the trigger will be to sort of throw the kitchen sink at the issue and really see the downgrades to outlook that you would like to see a bottom?
Well, just to be clear, Lisa, it's not like I would like to see them. And what do we expect to happen? I think the point you made is an excellent one. Keep the following kind of numbers in mind. Coming into the first quarter, the expectation was about plus 5% year-over-year earnings growth. Came in plus 12. Second quarter, expectation plus 6, came in plus 10. The setup coming in for the current quarter was basically plus 3. Expectation year-over-year growth, earnings plus 3%. They're basically somewhere between 1% and 2%. So there's actually a negative or surprises relative to expectations. That's right now. What's happened then looking forward in the fourth quarter? Expectations kind of at this time, before the earnings season began, was plus 7. Now it's looking at plus 5. So the idea of this cuts or a death by 1,000 cuts, that's essentially what's happening as you look into the fourth quarter, and then more importantly, as you look into calendar 2023. Our expectations right now are basically plus 3% earnings growth. So basically a modest growth, nominal dollars help sales. higher inflation, bad for margins. So you basically have a very modest level of profits. That's assuming soft landing, or basically economy continues to grow, although at below trend pace. On the other hand, if you have a recession, which more and more of the portfolio managers with whom I speak have that view, then basically you'd have earnings probably down 11%. So that's your starting point. And Lisa, the point is that currently expectations in next year is probably +7. So think in terms of the magnitude of diminution in terms of the cuts, probably coming from +7 down to potentially as low as -11%. And that historically has been the case coming into a recession, sort of the period 6 months ahead of recessions, earnings usually get cut by around 10%. So a lot of focus has been the impact of higher, Dom made reference earlier, the dollar, the impact of higher inflation. What does this do? Can companies, support their margins? The answer is there's downward pressure. The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.